Welcome to Fi Study Room, where we learn and achieve financial independence together. If you are ready to break free from the 9 to 5 and take control of your time, this is the right place. I'm PJ, a tech professional in the Bay Area. I don't hate my job, but I've always asked myself, is this what I'll be doing for the next 30 years? What happens if I stop one day? Does all my income disappear? I don't want to trade time for money forever. I want to be able to choose how I spend my time and where. 5 years ago, I dove into the world of financial independence. I was exploring side hustles, passive incomes, and real estate. In just 3 years, I've owned 6 properties, short-term rentals, long-term rentals, and flipped houses. This whole journey has been really wild and full of lessons, and of course mistakes. And I can't wait to share it all with you. This podcast is where I document my path to FI, especially for those who are in the tech and also who rely on W-2 income. If you've ever wondered how to break free from the 9 to 5, this is the right place. Let's learn and grow and achieve financial independence together here. For our first episode, let's talk about tax and tax advantage account. This is probably the most relevant and easily accessible topic for almost all of us. And this is also, I think, the first thing that I researched about when I started learning more about financial independence. And there are just like a few things that we really need to understand since we're relying on W-2, and they can really help us in early stages. A quick summary for the things that we will be talking about today. First, we will do a quick summary and review of the different types of tax advantaged account. Those are 401k accounts, IRA accounts, etc. It's just kind of a refresher to understand what are they and why they're important to us. Second, we will be talking about 2 specific strategies that are really relevant to high W-2 earners, the mega backdoor Roth and backdoor Roth, and who should be using that strategy and how to do that. Third, we will be talking about HSA, health saving account. So that's one of my favorite type of account, and just because it has so many tax benefits. After all of this, we will be looking into 2 specific questions. So those 2 questions are the ones that I have been thinking about a lot and researching about a lot when it comes to tax advantaged accounts. So the first thing is, now that you know, these are all the accounts that we contribute to. How do you specifically set goals for the year? Do you contribute early in the year? Do you contribute at the end of the year? What's a specific strategy that you can use? Second question, now that we have contributed to all these accounts and we have a bunch of money lying in our accounts, what type of fund that we can purchase for our accounts so that it can grow while we're doing other stuff in the life? Before we get into the details, here's a disclaimer. Please make sure to do your own research, and you may want to consult with a CPA and investment professional if you are not sure of something. There can be real tax implications to doing some of these things incorrectly. Okay, let's get into the major tax advantaged accounts that are available to W-2 earners. There are a lot of tax advantaged accounts for different W-2 earners. So the ones that I want to talk about today are the ones that I spent most time studying. So the way that I think about the major ones like 401k, like Roth IRA and stuff, is you can think about this as like a 2x2 table. So there is company versus individual account, and then there's also pre-tax versus post-tax account. So for company sponsored account, we usually call them 401k. So if it's pre-tax, then there is a traditional 401k account. So these are the accounts where like you can set aside part of your salary and then you can contribute to it. And then sometimes companies will also contribute to a certain percentage to your traditional 401k account. And there is also post-tax account. So for those account, people call those Roth account. I also didn't know why it was Roth. Is it short for something? But fun fact, it was actually named after a Republican senator named William Roth. And then he was the champion essentially for tax cuts and then expanding access to retirement accounts. Okay, back to our topic. So for individual sponsored account, we have traditional IRA, if you remember what I was mentioning just now. For traditional account, that's pre-tax. So for certain individuals, you can also set up your own IRA, so individual retirement account, and then allocate certain portion of your pre-tax salary to it. There is also post-tax IRA, so those are called a Roth IRA. So overall, now we're looking at 4 different types of major tax advantaged account, right? There's traditional 401k, Roth 401k, traditional IRA, Roth IRA. And then for all of those accounts, there is actually a contribution limit. So for 401k in total, I'm talking about both traditional and Roth 401k, you can contribute maximum, I'm talking about this year's limit is 23.5k. And the benefit is that company matches certain money, it's basic free money, so reduce your taxable income, so why not? And for pre or post-tax, it's really depending on, which tax bracket you will be in versus after retirement. So that decides whether you want to contribute pre-tax or post-tax. For individual accounts, the IRA account, there is a total limit of 7k per year. There is a certain income limit eligibility for contributing to individual retirement account. So I did some research. It says that you cannot contribute if your modified adjusted gross income is higher than 161k single or 240k joint. So you can do the research, but basically it's not like a 401k account. There is a certain eligibility criteria there. So these are the basic facts. I'm pretty sure most of you are aware. And then hopefully you are already leveraging those accounts. One thing that I learned is that there are ways to be able to contribute more and get more benefits from those accounts. So I'm going to be talking about 2 strategies that you can use for this tax advantage accounts. One is called Mega Backdoor Roth. Maybe you have heard it and just never know what it is. We can get into that just in a second. There is another strategy called Backdoor Roth. So Mega Backdoor Roth and Backdoor Roth. So obviously Mega Backdoor Roth will enable you to contribute more compared to the other strategy. So let's start with the big one. So this is Mega Backdoor Roth. What it is? It is essentially a strategy that allows you to contribute to 401k beyond the contribution limit. As we mentioned before, the limit is 23.5k for you to contribute. This strategy gives you the ability to contribute more than that. So you can essentially make after-tax contributions to your 401k and convert it to a Roth. So what is happening is that the IRA allows you to contribute up to 70k per year into your 401k accounts. This is the 2025 limits. They also limit the total amount you can contribute to both a pre-tax 401k and a Roth 401k to 23.5k per year. So now there is a gap. The 70k maximum contribution includes the company match. So that typically still leaves a gap in the amount that you're able to contribute. So let's do the math here. So in total, IRS allows you to contribute 70k per year, right? And then for your personal contribution is 23.5k. So you use 70k minus 23.5k. There's usually also a company match component. So you minus that much amount that you are getting, basically the free money that you are getting from your company. Whatever left is the total remaining to contribute to after-tax 401k. So IRS does allow you to make this after-tax contribution, up to that 70K limit. So I'm using, let's use Meta as an example. For example, in Meta, we have 70K IRS limit, right? And then 23.5K for the ones that you can contribute. And company contribute 11.75K. So that actually leaves you 34.75K. So almost 35K total remaining to contribute to after tax. So why would you do that? Maybe you will think about like, why would I want to do this? So if you can take your additional 35K from your salary and then you contribute to this account. And then your money, because you already paid tax on this, so your money can grow tax-free in this account. So there's no capital gain tax, no other tax that you need to worry about when you eventually take it out from the account. If you really think about the compounding impact from this additional money, that's actually a lot. That's what we call mega backdoor, because 35K is not a small number. Coming into the next strategy, Backdoor Roth. The reason that it's called Backdoor Roth instead of mega backdoor because it's a much smaller amount, but still money. So there is another strategy that allows people with higher income to contribute to a Roth IRA even if they exceed the IRS contribution limit. So for people with higher income, you can contribute additional 7K to a Roth IRA through this approach. Let's go a little bit deeper into that. The way that you do this is you can create a traditional IRA and you contribute to a traditional IRA, but you convert the traditional IRA to Roth IRA within 60 days. So the gains before the conversion are actually taxable, but the gains after that is not. So what you are doing here is essentially you are contribute additional 7K and then you have already paid tax on this, right? Because this is from your after-tax salary. However, once you have this in the Roth IRA account, this amount of money will grow tax-free. One thing to call out is that there are tax complications and considerations, especially if you already have a traditional IRA or rollover IRA account. So please do your own research before actually trying this. Apart from 401k and IRA accounts, there is a different account that I need to mention here because it's really one of my favorite type of accounts. House saving accounts, HSA. It's just there are so many benefits with HSA. The way that I see it is it's kind of like a 401k plan, but a smaller one. So the way that it works is you contribute your pre-tax money into it. And so it will grow tax-free in there. You can use that money for investment to buy any type of different funds or product that you want. And you can withdraw for qualified medical expenses. And that is tax-free. After age of 65, you can use that money for anything. One thing is that when you take it out after age of 65, you have to pay regular income tax. It works the same as 401k plan. One more thing to make it even better, some employers will actually match certain amount of your contribution. So similar to 401k, you are contributing by yourself and then you are getting some free money from the company. So for me, it really seems like a no-brainer, especially when we're younger and you don't expect too much medical expenses. So this is really the perfect time to contribute and then have your money grow earlier because the money that you make when you're younger are usually more valuable. Things I mentioned just now are definitely not everything, definitely not all the tax advantage accounts that are out there. As I learn more, I research more, I'll also be sharing more with everyone here in the podcast. So now that we have covered the major ones, we understood what are 401k, what is IRA, what is HSA, and we know the maximum limit that we can contribute each year. Now the question is, how do we set goals for each of this account? When should we contribute and how much we should contribute each time? I'll be sharing my plan for 2025. Maybe you can use this as a starting point to think about how you want to plan your contribution and what makes sense for you this year. So before this year, actually, I did not really understand what is mega backdoor and what is backdoor. So this year, on top of the regular contribution, I'm actually making an additional 42K contribution to my tax advantages accounts. So the 42K comes from 35K comes from the mega backdoor, and 7K comes from Backdoor Roth IRA. In total, I'll be maxing out my 401k contribution, which will be around 24K this year. And after tax 401k, that was the 35K that I mentioned just now. And my company will match around 12K for 401k. And for Backdoor Roth, that's 7K. So if you sum everything up, so that's about 77K, and that's 42K more compared to before. This is a lot of money, and I'm contributing it right now, and I expect it to grow freely in my tax advantage account. Imagine doing that every single year moving forward while I'm still working. That's a lot of a gain at the end. So for 401k plan, for all the contribution that I mentioned just now, I'm going to start in the first day from January 2025. And by end of May 2025, I should have already contributed everything. So my strategy is basically timing the market is more important than timing the market. So I will try my best to max out as early as possible, which means that for the first 5 months, I'm taking home very minimal pay from each paycheck. The second strategy is for HSA. So I will also be maxing out my HSA plan for my individual HSA plan, which is around $3,550, and the company matches $750. So in total, that's going to be $4,300 in total for the year. So yeah, that summarized my plan for the year. Hopefully this was helpful for you and you can start thinking about how you want to start contributing as well. Now that we know how to contribute to all those different accounts and when to contribute, what's the maximum limit that we can contribute to, the next question will be, now that we have all the money in the accounts, what do we do with them? Which funds should I purchase to maximize the profit? Usually the default for example, for 401k plan is a target fund, date fund. For example, when I joined the company, I remember the default option was a 2065 target fund, which has a combination of different types of stock market and also bonds. A lot of people actually don't like it. I didn't really realize what was wrong with it until recently, because I was reading more and more and realized that you don't really have to go with the default. There are many things that you can try and do and adjust for your own portfolio for 401k plan. Things that I've seen the most about target date fund, whether it's good or not, it's usually around whether it's too conservative. Because it's true that if you compare it, let's just use the one that I initially opted in, the target date fund for 2065. You compare the gain from that fund to, for example, US stock market, it's much lower. In the past 10 years, the growth rate for the fund that I opted in, it was 7.7%, but US stock market was growing at 11.3%. So that's a pretty big difference. I've been looking at a lot of different options of how to adjust the portfolio. First option, US stock market. It's really popular. A lot of people just choose it because of the high performance in the past 10 years. It's 11%, as I mentioned. There is also international stock market. It was growing at 10%, slightly lower than US market. There is also bonds, which is 1.2%, compared to much lower compared to the other two options. But of course, it's usually much lower risk as well. A lot of strategies that I've seen from other people's research is that they just go with a certain distribution or combination of all the options that I talked about. So I've seen people opting 50% of US stock market and 50% of the international stock market, or a lot of people just all in US stock market. They buy things like VTI, the index fund for US market. And a lot of people also just choose target date fund and chill. If they feel like it's too conservative, they just extend the dates for the target fund. So for example, the one that I got as a default is 2065. They just choose a different date fund, for example, 2075. What it does is that it will make the target fund more aggressive than the 2065 fund. That would work too. And some people will go with all the options that I listed above, some sort of combination. So for me right now, because I'm at the early stage of my career, I actually changed my portfolio to US stock market. I'll probably change it down the road at some point to a more conservative plan as I get closer to my retirement age. But these are all the options that people have been thinking about. Just choose the one that you feel most comfortable with. Be conscious of what you're choosing, and don't just go with default like what I did in the past few years. And just understand your option and live with it and chill. Summarizing what we talked about today. We reviewed the different types of tax advantage account, and we tried to categorize them. We talked about 401k and IRA. 401k is sponsored by companies, and IRA are individual sponsored accounts. And depending on whether it's pre-tax contribution or post-tax contribution, we call it traditional versus Roth. After that, we discussed about mega backdoor Roth strategy and backdoor Roth strategy. So both of the strategies are essentially enabling high salary earners to contribute more to 401k or IRA. After that, we talk about health savings accounts and how good it is, especially for people who are just starting out in the career and who does not have too much medical expenses right now. It's just a great way to accumulate money, accumulate wealth, and have the more money in the tax advantaged accounts. We also talked about how to set specific goals and contribution plans for the year for different types of accounts, and also what type of funds to purchase to maximize your profit from those accounts. That's it for today. Moving forward, I'm hoping to share my favorite personal finance books and my real estate journey. Please let me know what are other topics you will be interested in and leave comments. See you next week!